I've been beating the drum the past, I guess, couple weeks, maybe the entire time we've been doing the show, about how I think there's a lot of optimism about the economy right now, and it's just not warranted. We talked about the housing crisis. We talked about how right now everything seems fine. Everybody is paying their mortgages for the most part. People are paying their rent because people are getting unemployment. There's been bailouts. The banks are have been shored up. But Bob Schiller, who created the Bob Schiller or the Case Shiller housing index, he teaches economics at Yale University. He's been saying that houses are overpriced, that they're at all-time highs. This isn't sustainable. This isn't sustainable, and we should see a crash. And he was saying this last September. He wasn't saying this since coronavirus broke out. He was saying last September that the housing market was in trouble. And so people are saying, "Oh, well, everything's going to be fine." We quoted that guy, and I believe it was Houston, who said, "Oh, my realtor told me just wait a couple of months and everything's going to turn around." Everything's not turning around. Carl Icahn, he's 85, he's kind of a Warren Buffett type, and he's made a bunch of money here actually in the past few weeks. He bought oil at negative prices because that's what I mean. Somebody had to do it, right? If the price of oil was negative $40 a barrel, he owns part of it was like an auto parts and refinery business that he owns, and so they cleared their tanks and they just took as much oil as they possibly could at negative prices. And I shared an article. I think you're sharing it now, but it's he predicts more economic turmoil, and he says the future is just too unpredictable for the S&P 500 to be trading at 17 times 2021 earnings estimates. You really cannot justify that multiple, Icahn said. Short term, you may have some big downdrafts. And I think this is right. He's also betting that commercial real estate is going to get hit hard. That's going to be first. It's going to be commercial real estate, then it'll be housing. But real estate in general is in big trouble. Already, we've seen REITs, those are real estate investment trusts for commercial real estate in New York City, has dropped by 50%. Because people, if they can leave New York City right now, they will. 20% of New York City has coronavirus. But it's not just about the coronavirus. These houses and office buildings and everything else was overpriced, like I said, last September. And nobody's taking this seriously. And the reason why nobody's taking this seriously, if you ask people either in the investment community or in the real estate industry, what they'll tell you is, well, we fixed the regulatory problems. What happened in 2007, 2008 was people were getting subprime mortgages because there weren't the regulations to prevent people from getting bad loans. And that's just not it. This argument, what this is going to come down to is whether monetary policy or regulation is what stabilizes the economy. My money and Bob Schiller's money, again, Robert Schiller is a Nobel laureate who predicted the 2007 housing crisis, who created the standard housing index and teaches at Yale University. He says the real estate market's in trouble. Carl Icahn, 85-year-old billionaire investment wizard, believes that real estate's in trouble. But everybody else is it's just all happy talk. They think that everything is hunky dory and we just have to wait this out and we're gonna survive. And yeah, eventually the market will come back. But right now, the investments, the fundamentals just aren't there. As you said, the price of the S&P right now is based on rosy predictions for next year, for 2021. That assumes that those rosy predictions are going to come true. And with this much uncertainty, how can you possibly value the stock market that high? So that's the big question.
Well, we've had a constant theme on our show that it, once again, people are using the pandemic as cover for their bad business practices that's been going on in some cases for decades, and a lot of that is starting to come to pass now because of the current crisis. But we've kind of maintained that a lot of the fundamentals were bad to begin with.
Yeah. The market dropped about 30% earlier this year, and then it's come back. So now we're only down 16% for the year. So we've gained about half back of what we lost, but it just doesn't make any sense. The fundamentals aren't there, earnings aren't there. The market is just foaming because we've dumped so much liquidity into the market, and that's not going to carry us forever. We said last week that the price of a house now is 5 times your annual salary, where it used to be double. It's now 5 times your annual salary, which is outrageous, absolutely outrageous. And we just accept it because we say, oh, interest rates are so low. Interest rates are so low.
One thing I've always wondered about when it comes to these kinds of issues, I see it in the stock market, I saw it in the real estate crash, with the Great Recession, is nothing seems to ever bottom out anymore, thanks to these stimuluses and everything like that. Like I've
Right.
kept a pretty close watch on the stock market through sort of E-Trader, looking for those quote unquote bargain stocks. And I can tell you, all you got to do is look at that little ticker that gives you that 52-week window, tells you what the lowest price of the stock has been in the last year. And guess what? Most of these stocks aren't there. They're not even at their lowest point, in the last year, the last 52 weeks. They're still trading above that. And that to me is just that's pure inflation. That's all that stimulus money that was thrown in there, and these stocks are overvalued. There's just no way to get around that. With everything going on, how can these stocks still have greater value than they did, say 6 months ago, or even a year ago? That's just, it's not possible. It doesn't make any sense.
Yeah, and Robert Schiller, he made this excellent point that normally when a recession happens, it's because you have a panic, and so it's largely psychology. The run up is built on psychology because people are very overly optimistic, and then you have a big crash, and everybody becomes overly pessimistic, and the recovery usually doesn't happen until people lose hope for a recovery. And when people are sort of used to the new normal, then the market recovers. But he says this is different. This isn't psychology. This isn't the madness of crowds. This is like a real life plague of locusts. Something real and tangible has happened to the economy to shut down the economy. And we're acting like this is just a normal boom and bust. And those things we've tried in the past are going to bring us back, and things are going to be better in the fall. And he just doesn't see it.
No, I don't see it either. Like I said, I think many of the weaknesses have been exposed, and they're just gonna get worse. And propping everything up with the national credit card, I don't think is going to help. I think it's going to cause inflation eventually. So
Yeah, it's going to work for a month or two, and then we're going to see reality is going to set in. Unemployment benefits aren't going to last forever.